Compound interest is the simplest, most powerful financial concept you will ever learn, It is the idea of your money making money for you. You earn interest on the initial money you save. Then, that interest starts earning its own interest. This process repeats over and over again, creating a cycle of growth that can turn small, consistent savings into a massive fortune. It is not a get-rich-quick scheme. It is a get-rich-for-sure plan, powered by time and consistency. The key is to understand that the money you earn is not just sitting there, it is working for you every single day, even while you sleep. This is the fundamental secret that separates savers from wealthy investors and makes financial freedom attainable for everyone, not just the ultra-rich. Imagine a tiny snowball at the top of a very long snowy hill. When you give it that first gentle push, it starts rolling. At first it barely grows, it picks up a little bit of snow, then a little more. But as it continues its journey down the hill, it gathers more and more at an ever-increasing rate. The bigger the snowball gets, the faster it grows, until it becomes an unstoppable avalanche of wealth. Your initial savings are the tiny snowball, the returns are the fresh snow, and the long hill is time. The more time you give your money to roll, the larger your financial snowball will be by retirement. To harness the power of compound interest effectively, you need the right tools. Retirement accounts with tax advantages, like the 401k and the Roth IRA. These are not investments themselves, they are accounts that hold your investments and give them a tax-advantaged place to grow. Think of them as greenhouses shielding investments from annual taxes so they can compound faster. A 401k is an employer-sponsored plan that lets you contribute a portion of your paycheck before taxes. Pre-tax contributions lower your taxable income, and your contributions and earnings grow tax-deferred until withdrawal in retirement. That deferral lets 100% of your earnings be reinvested and compound. The Roth IRA works the opposite way. You contribute after tax, your money grows completely tax-free, and qualified withdrawals in retirement are tax-free. If you expect higher taxes later, this can be incredibly powerful. Imagine withdrawing $1 million without owing the government a cent. That is the power of a Roth IRA. So, which is better? You do not have to choose just one. A common strategy is to use both. First, contribute to your 401k enough to get the full employer match, free money. Then, prioritize funding a Roth IRA up to the annual limit. If you still have more to save, increase your 401k contributions. Using both creates tax diversification and flexibility for the future. Once you have chosen your accounts, the next step is to fuel your compounding engine with investment returns. Over long periods, the stock market has historically provided average annual returns in the range of 8% to 12%. These are long-term averages. There will be good years and bad years, but consistent investing over decades captures the range. Imagine saving $500 each month. At 1%, after 30 years you would have about $210,000. A far cry from $1 million. Invested at 8%, after 30 years it grows to roughly $750,000. The difference is staggering. At 10%, it swells to over $1.1 million. At 12%, more than $1.7 million. That is the exponential nature of compounding. The difference between 8 and 12% is not just 4%. Over 3 decades it can mean an extra $1 million. Choose growth-oriented, low-cost index funds. Time magnifies returns. Do not chase risky bets. Build a diversified, low-cost portfolio and let the engine of returns do the heavy lifting. Your rate of return is a powerful multiplier on your consistent savings. Theory helps, but seeing numbers makes it click. Let's break down the path to $1 million with simple, step-by-step examples at 8%. Time is your strongest ally, more powerful than a large income. Example: A. Starting at 25, saving $400 monthly, for 40 years at 8%. The account grows to about $1,245,000 from only $192,000 in contributions. Over $1 million is pure growth, your money working for you. Example B. Start at 35 and you need about $820 monthly to reach $1 million by 65. Example C. Start at 45 and you need roughly $2,000 monthly. A shorter hill means bigger pushes. The single most impactful decision: start today, no matter how small the amount. Right. Time lowers the savings required. Delay raises it. If compound interest is the engine, the 401k employer match is the high-octane booster you get for free. An employer match adds money alongside your contribution. A common formula is 50% up to 6% of salary, an immediate guaranteed 50% return. Ininig in 60, $70,000. A 6% contribution is $3,600 per year or $300 per month. Your employer adds $1,800 per year, $150 monthly. So $450 is invested total. Skipping the match is like turning down a raise and leaving free money on the table. Over 30 years at 8%, that $150 per month can grow to about $225,000. First rule: contribute enough to get the maximum match before extra mortgage, taxable investing, or even your Roth IRA. Secure the match first. It is the single best investment you can make, accelerating your road to $1 million. Building wealth is also about protecting it. 3 obstacles: investment fees, taxes, and poor diversification. Ignore them, and your bucket leaks, even as you pour money in. Fees are silent killers. 1% on 100,000 is 1,000 per year, and the loss, compounding on that money. Over 30 years, 1% can cut your nest egg by nearly 30%. Be a fee avoider? Choose broad, low-cost index funds and ETFs. Taxes drag returns too. Inside 401ks and Roth IRAs, growth is sheltered from annual taxes, allowing uninterrupted compounding. Do not gamble on a single stock or your company's stock. Diversify across hundreds or thousands of companies and sectors. The easiest way: S&P 500 or total stock market index funds. One company can fail, the market as a whole endures. Combine pre-tax and Roth balances to manage retirement taxes and keep more of what compounding built. The goal is the same, but the path differs by starting age. Here are 3 blueprints at an 8% return. Start at 25. About $300 per month can reach $1 million by 65. $400 per month can top $1.2 million. Start at 35. Plan around $820 per month. It is achievable. Act with urgency. Start at 45. Aim for $2,000 per month and use catch-up contributions after 50. Use a compound interest calculator to tailor these plans to your income and timeline. No matter your age, automate, invest in low-cost index funds, and stay consistent. The path is simple, but not always easy. Avoid these common mistakes. The biggest mistake: not starting early. Every year you wait makes the hill steeper and demands larger contributions. Second, ignoring the employer match. Free money left on the table. Third, paying high fees that siphon off hundreds of thousands over time. Fourth, emotional timing, panic selling, and trend chasing, usually worse than steady investing. Fifth, lack of diversification, especially in your own company stock, doubles your risk. Solution: stay diversified, choose low-cost funds, and rebalance once or twice a year. Discipline wins the long game. Knowledge is potential power. Action creates results. You now have the blueprint to build $1 million nest egg using compound interest. The journey is long, but it begins with a simple step taken today. In the next 10 minutes, log into your benefits portal, find your 401k, and set your contribution to capture the full employer match. Do not log out until it is done. Next, open a Roth IRA, link your bank, and set an automatic monthly transfer. Even $50 counts. Make it automatic. Then choose low-cost, broad index funds. If you are young, consider an 80-20 stock-bond mix. Set it and forget it. 3 steps. Secure the match. Automate your IRA. Choose low-cost funds are your launch sequence. Start the countdown today.